Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about fixed income. We're talking particularly about fixed income ETFs. Very important topic right at the moment. And with us today is Jarrad Linzie. He is the global head of fixed income index research at MSCI. He is responsible for the development of MSCI's fixed income product suite and the strategy to increase market share across the franchise. Now, prior to joining MSCI, Jarrad served as a managing director at JP Morgan, where he was the global head of index research product development for the investment bank. Jarrad holds a Bachelor of Arts degree in economics and marketing from the University of Maryland. So welcome to the podcast, Jarrad.
Thank you. Thank you for having me.
Now, I'd like to start off with something that's exceptionally important because, we do get a lot of experienced people on the podcast, but very few that have as much experience as you do in ETFs. You got a lot. So during your long tenure in the FIETF space, you must have gained some interesting views into things on how current trends will evolve into the future, et cetera. So can you talk a little about how your view of the future is going from here?
All positive from what we gather. I would say from a fixed income perspective, ETFs currently represent about $2 trillion in AUM. It's probably moving somewhere around 15% per annum. But the interesting thing in the evolution is passive versus active.
Right.
And when you start to look at it, we've seen a huge amount of growth in the active space. And there's a lot of new managers coming in that are not your traditional ETF managers because everyone understands the BlackRocks, the Vanguards of the world. But then now you have the next wave of ETF managers that are very big managers in fixed income. So your JP Morgans of the world, your Alliance Bernsteins of the world, they're looking PIMCOs. They're looking to kind of come in and penetrate the market. And the way they're actually penetrating the market is a little bit differentiated where the lion's share of the AUM that exists today are with your traditional market cap weighted products, whether it be treasuries, securitized products, global ag type products. But now they want more alpha generation. Well, how can they differentiate from the incumbents to actually gain a bit more market share? So a lot of that is more about extracting value from a particular asset class or index itself or strategy. And now what we see is that a lot of these strategies are starting to resonate more, right? So they want to see more factors or sector rotation type of strategies or alpha generation using, quant-based systematic strategies in itself, right? So I just think moving forward from an ETF perspective is going away from your traditional vanilla type of products, more into the sexy products. The only thing is that we need to be mindful when they transition into those products, or at least bring those products up to speed, is more the turnover, right? Because anytime you add in additional factors to a market cap weighted strategy, turnover comes into play and they say, well, the performance is X over what the incumbent is or whatever the index strategy. But if you don't factor in transaction costs, then it kind of bites you in the foot a bit.
Right. But I wonder what is underpinning that. Is it the general acceptance of quant, which has had quite a run in the last couple of years? Is it the higher yields? What is pushing this?
Well, yields are definitely high, right? They're great right now, and they're going to be great for a fairly long time, in my respective view. But I think what it is that how can you get someone else to buy another product that's exactly the same thing?
Exactly. Okay. So
right? So it's more about differentiation, right? It's no longer about give me the same investment grade product that BlackRock may have, and even companies like BlackRock, they actually have systematic strategies on investment grade because their clients want more value out of the product itself, right? So I think that's where it comes into play, where it's not about your traditional vanilla market cap weighted products anymore. It's about, well, what can I provide that's a bit more differentiated, that will provide more alpha generation strategies that's still relatively liquid, at the same time, that's transparent, but again, provides a bit more value to the end investor.
Okay. Well, one of the things that I think is interesting as a third-party viewer of this, but somebody who used to work at a bond rating agency, is that during your years of building indices, one of the things that has really changed is transparency has generally improved. And that is an exceptionally difficult thing to do because transparency, especially in some sub-asset classes, is not easy. And at lower levels of transparency, one could argue that indices were more valuable because the insights they provided to investors who didn't have to invest the time in doing that. Now, how do you think the role and purpose of those indices will change amid that trend towards more transparency?
So there are asset classes that are transparent. There are asset classes that are not as transparent, right? So you look at U.S. Treasuries that are extremely transparent, right? Super liquid. But there's times where things break, right? So if we go back to COVID, everything was broken during COVID. I recall the times that all index providers actually did not do a monthly rebalance because there was a lack of price transparency across the board.
Oh, I didn't know that happened.
Yeah,
okay.
So exactly, right? So it was really interesting because what was going on is that there was huge amounts of outflows during COVID, but what everyone was doing is basically selling off all of the stuff that they had price transparency on, right? So, and typically what that would be is all your investment grade stuff, all your treasuries, you start selling that stuff off because the things that were, let's call it, I'm not even going to call it speculative, but further down the credit curve had wider bid offers, less transparency, and they were like, well, I want to hold on to that right now because I would take a huge hit in regards to that. So I think right now we are in a stage that there are transparent markets, but there's still a lot of inefficiencies when we think about it as a whole. I mean, if we think about what trades daily, there's the lion's share of our prices that we receive from our third-party pricing provider today. A lot of it is matrix priced. Right, so it's not like it's traded every day, but there is transparency where you have a good idea of how they calculate those matrix prices, et cetera, right? But there's still loads more that we can actually do. And we haven't even scratched the surface in emerging markets when we think about the local market perspective, because what's really interesting when you think about overall asset allocation, EM represents, let's call it, 25% of the overall debt stock. EM, if you add in China, represents about 45 to 50% of global GDP, but EM only represents about 2% of allocation from pensions, right? Yeah, because the lack of transparency in their mindsets, right? So I think having index products still will help pensions and asset owners understand how things are continuously evolving and provide them that necessary transparency, but it's still a long ways to go. And again, in equities, you can go and figure out, what's the trading volume of XYZ stock?
Right.
Try to find that in fixed income. It just there isn't anything, right? So what we do is we provide proxies, and there's I guess there's turnover in trading numbers within certain regions, but they don't all come together in the right way, right? So that's why you have certain, let's call it, we have a partner that produces liquidity scores, relative liquidity scores with market access. And again, you wouldn't need liquidity scores if you just had trading volume. Right? Because that's effectively, your liquidity
is there.
But the reality is you still need that respective assessment because you don't have that full transparency in the market itself.
Right, and as you say, this is a pretty big opportunity of market because we're talking about transparency in the EMs. I guess you're mostly talking about sovereigns.
Yes, well, sovereigns but local markets more than anything, right? Because when you think about emerging markets as a whole, everyone understands external debt. Everyone understands you look at the MB. There's nearly, let's call it, $600 billion dedicated to some sort of emerging market sovereigns. But when you think about the overall depth of the market, EM hard currency sovereigns is probably a little bit over $1 trillion and a half in debt stock.
Right.
Corporates, hard currency corporates, maybe call it $2.5 trillion.
Oh, that's that much. Okay.
Right?
Yeah. Okay.
Local market sovereigns is more like $8 trillion in debt stock.
Okay.
Local market corporates is more like 6 and a bit in debt stock. Right. So it's much bigger than what it is in the hard currency space, but there's much more allocation in the hard currency space because that's what they know today. But there's needs to be so much more transparency in the market itself when we think about EM local.
Yeah. This is an area that is exceptionally interesting right now because of that, because of yields, because of the risks. There's just a lot going on. The other place that is very much at a crossroads right now, well, like everything, but particularly is sustainable investing.
Yeah.
And it has sure evolved a lot during your time.
Yeah.
And so,
Yeah.
You did some excellent research last year on the glide path mechanics of decarbonizing portfolios. And by the way, you can still find this on MSCI's website. I recommend everyone read the paper. But to give people a little incentive to go search for it, can you talk a little bit about what you wrote about?
Yeah. So glide path was a really interesting one because there's a lot of, let's call it, sustainable solutions that exist today. Some of it will tilt based on ESG. Some of it will look at specific decarbonization, like Paris-aligned benchmarks or climate transition benchmark, climate change benchmarks. But the biggest conundrum that a lot of asset owners has is that, look, they already have assets today. For them to transition to a Paris-aligned benchmark or climate transition benchmark would cost them a lot of money, right? And we ran this actually scenario for an asset owner that they were looking to kind of transition something like $12 or $13 billion of investment grade credit. And we ran this regression where that transition would cost them something like $110 million, effectively. Right. And so we went back and said, well, what can we actually produce that would ease that transition, but also meet their respective sustainability goals? And some of those goals really differ from client to client. So glide path in itself, although we have it as a off-the-shelf type of benchmark or index, we look at it as more as a tool than anything. Right? Because we talk about transitioning, we talk about glide path, and most will say, well, glide path is just a decarbonization type of feature, right? Glide path is not a new term by any means, but we took a step back and really reevaluated. We said, we want to look at glide path as a transition. And some will transition towards sustainability, but some will also say, look, I want to transition my portfolio to yield and credit quality. And you could do that as well, right? So that's the beauty of glide path. But going back to the whole sustainability front, which is a big component of what we're trying to do at MSCI, right, is capture that transition effectively, because look, we all know that the market is pretty saturated with incumbents. Bloomberg is known for investment grade credit and govies. JP Morgan is known for EM. FTSE is known for developed market govies. You have ICE known for high yield, effectively from the Merrill days, and then you have iBox known for credit as well, right? And CDS effectively, right? So trying to get managers away from their current products is almost impossible.
Right.
And I always bring up the whole notion that managers change benchmarks once every 30 years.
Right.
And if that's the case, then, well, what can we do from an MSCI perspective? But this is a once in every 30 years, effectively, is because managers are looking to transition towards sustainability.
Right.
And different features of sustainability. Some care about more forward-looking metrics like, let's call it green revenue and science-based targets. Some care about decarbonization only. Some care only about portion of decarbonization, where they say, I only want to focus on scope 1 and 2 data as opposed to looking at scope 1, 2, and 3 data sets. So I think it really, runs the gamut across the board. But from our perspective, we wanted to solve the problem of transition, cost, tracking error. The tracking error is the interesting part, because I remember when I rewind, let's call it about 7 years ago, when I developed JP Morgan's ESG emerging markets product.
Okay.
All right. Clients would come up to us, look, we're willing to sacrifice a little bit to do the right thing. Not anymore.
Right.
Right. Those days are over.
Right.
Right. The first question you get from asset managers or asset owners is, well, what is the tracking error toward my benchmark?
Yep.
They do not want to sacrifice anything.
Right.
Right. However, but there is still strong goals and ambitions towards sustainability. There's no doubt about it. Now, look, I would say Europe is moving a lot faster than all the other regions. The U.S. is relatively slow. Asia is starting to pick up. I mean, in the U.S., you have pockets of it. You have pockets of it on the coasts, effectively, right? But there's even times where, look, and now we have a new administration, et cetera, right? But there's been times that clients come to me and say, Jarrad, can we embed sustainability without calling it sustainability?
Right. Right. Well, that's going to be one of the things a lot of people are going to do.
Mm-hmm.
And while Europe is way ahead, Europe has always sort of led through top down from regulatory perspective,
Yep.
and the U.S. has more been bottom up from investors.
Yeah.
So it's not too surprising. And if you think about it in the old ways, ESG.
Mm-hmm.
U.S. it's mostly the G.
Yeah.
And you need that. It's exceptionally important.
Yeah.
The other thing that is happening now is, let's call it a bubble in AI stocks.
Okay. Yeah.
But I'm pretty sure the bubble's going to blow. Well, we're still going to be left with a couple, and it's going to be part of our lives going forward.
Mm-hmm.
So there's been a lot of speculation about how it might impact retail investors. So I'm sure you have some thoughts about how it'll impact retail investors and their allocation to indices.
So at MSCI, everything is about AI. It's AI everything. But I think to start with, it's more about efficiencies than anything.
Okay.
All right. In order to provide best-in-class products to any investor, retail, institutional, across the board, you need to make sure you figure out ways to mitigate mistakes effectively.
Okay.
All right. So a lot of the AI that's going in today is more about, all right, well, how can we make things more efficient? How can we make things a little bit easier to the user of our data in itself? So we have these thing called research insights where anyone that's subscribed to MSCI One can go into the database or go onto the platform, ask a question, and get an answer effectively, right? So I think it's really about efficiencies and providing data a bit more rapidly than anything. But with that being said, we're also thinking about it on the index side. Is like, well, Gen AI is one aspect, but you could, let's not forget about machine learning, right? And there's a lot of data, especially within the fixed income space, to really create new innovative products using machine learning, in my respective view as well.
Okay, so it sounds like you're talking about operational efficiency and client service.
That is absolutely correct. That's the starting point. I think that is the starting point. Until we get to a space, because the one thing in fixed income, it's a little bit different from equities, right? Because the lion's share of any equity index effectively is done in the secondary market,
right?
As opposed to in fixed income, it's really important to have a rules-based strategy because the lion's share of the activity is done in the primary market. Right. That's where managers kind of extract a lot of the alpha. But it's hard to do that when you have a black box or an optimized approach in order, because then you get left with something that you was like, well, now I have off-index bets or tracking error toward my benchmark because I thought it was going to go in. It's not going to go in. I don't want to sell it now, et cetera. So in my respective view, it's really important to have rules-based strategies. And now, we think that at some point we can plug in all of our data, all of our insights, right? But it's humans that need to, figure out or train the models and such, right? And create innovative products using all of our data suites effectively.
Yeah, that's fascinating. I never really thought about the primary, secondary nature of those things and how AI could affect that because they are excellent at rules, right? So that is interesting. So, well, thank you, Jarrad. This has been exceptionally fascinating to think about this, think about how hard your job is and that it only changes every 30 years. So everyone, I'm sure, is feeling a little sympathy for you. But thank you for sharing your very long tenure in this job with us. And so thank you for being here.
No, thank you for having me. Appreciate it.
And thanks to all of you who've been listening to this podcast. Really appreciate your time. And we'll see you next week. Until then, I'm Rob Rowan, and this has been Compound Insights.